Charles Schwab on the verge of a multi-trillion-dollar implosion. Concerns about a recession and the effects of future rate increases have everyone on edge as we assess the present economic conditions. However, despite being an established and well-respected company in the world of finance, one of the world's largest financial institutions, Charles Schwab, is facing severe challenges as a direct result of the ongoing economic downturn. The failure of Silicon Valley Bank and a few other financial institutions has put tremendous pressure on the largest brokerage firm in the United States, with $7 trillion under management. Now, as investors from all over the world scramble to figure out what to do next and how this will end as the firm tries to avert total collapse, we are currently seeing what may be the last days or the demise of Charles Schwab. Hi, and welcome back to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to like this video, subscribe, and click on the notification bell to stay updated with our videos. Over the past 50 years, Charles Schwab has built a reputation for excellence in providing a diverse array of financial services to clients worldwide, amassing $7 trillion in assets under management and 35 million account holders. But even though they are often considered to be one of the most successful financial institutions currently operating, this does not necessarily make them one of the most trustworthy. Stock prices have fallen dramatically and don't appear to be recovering despite recent comments from the company's chief investment strategist, Liz Saunders, who said that Silicon Valley's demise is an obvious sign that something is broken in the financial world. The previous month has seen Schwab's biggest share price drop in 35 years, with shares dropping by 33%. Low interest rates served as a foundation for their $7 trillion empire, which is now beginning to fall apart. In addition, this crisis does, in fact, exist, and contrary to popular belief, it will not go away on its own. Even if Charles Schwab is a major financial institution and not a local bank, we may still see weaknesses if we dig down far enough. It is evident that Charles Schwab made a major mistake after making significant investments in long-dated U.S. Treasury securities. They took on too much risk because they believed that the risk-free return on U.S. bonds was indeed risk-free. Unfortunately for Charles Schwab, interest rates rose sharply during the quickest rate hiking cycle in history. As a result, these bonds' value decreased significantly by around 40%, and the bank incurred unrealized losses of tens of billions of dollars. On the other hand, Charles Schwab still anticipates earning $1 for every dollar invested in the bonds if they can hang on to them until maturity. The issue arises if they had to sell their bonds, which they could be compelled to do. In that case, Schwab would suffer a $12 billion loss in addition to the $15 billion in losses they haven't recorded yet on their balance sheet. However, with $7 trillion in assets under management, a $27 billion loss can't be considered all that catastrophic. Even if such assets aren't theirs, they don't help because they only hang on to and manage them for their clients. They're also under pressure from other areas since their clients are now putting greater demands on them because they aren't giving them enough interest on their deposits. As a result, Charles Schwab must raise their expenses if they don't want to lose consumers, who would be the ones to bring down this house of cards. Now everything circles back to the current state of the economic environment and the Federal Reserve. When it comes to the Fed, you may have heard the saying, "The Fed will tighten until something breaks." This basically implies that when the Fed tightens, they are aiming to harm the economy in order to stop inflation from escalating. And they often wait for the job market to collapse since unemployed people would stop spending money, which lowers inflation. However, this time around, the banking industry collapsed before the labor market did, and the demise of Silicon Valley Bank and Charles Schwab might be next. Even if a company like Charles Schwab makes adjustments, it's unclear if the Fed will modify its actions. They assert that the only thing they are concerned with is effectively combating inflation. Because the Fed has proven in the past that it is selective about when and how it intervenes during times of crisis, it is very challenging to speculate on what action it may take in the future. Although practically every bank in the world is currently dealing with a similar situation, Charles Schwab is being struck far more severely than most other blue-chip companies, and many people still have no idea why. Now, Charles Schwab owns around $20 billion worth of intangible assets, which means that if they dissolve the firm, they wouldn't really recover anything for these assets since they wouldn't be able to sell them. Though these assets have worth, they are notoriously tricky to evaluate, even more challenging to sell, and may or may not be worth anything in the future. But fortunately, Charles Schwab has a safety net. They have access to the new emergency loan program offered by the Federal Reserve, which may give them over $200 billion in cash to deal with potential deposit withdrawals from customers. However, if Charles Schwab begins to experience significant issues, many other banks may experience similar problems, and there is a very real possibility that the $200 billion will not be sufficient. Investors had begun to significantly doubt the company's future as a result of the recent turmoil in the banking sector, which is primarily the cause of the share price decline over the past month. The share price hasn't decreased by 30% to correspond to the 30% decrease in consumers' assets or earnings. This share price decline is almost solely the result of the market attempting to price the likelihood of the entire bank failing. Additionally, it has been reported that the company's earnings will be lower than anticipated. While this is not necessarily fatal, it is still bad news due to consumers moving their funds into more lucrative accounts with greater returns and maybe more secure places as well. Their cost of borrowing has been continuously rising as interest rates increase, and their deposit base has been decreasing. Furthermore, it decreases the capital they have available to them to generate income. To address these concerns, management recently mailed a letter to shareholders in which they argued that the concentration on unrealized losses in the maturity portfolio was misleading. However, as we are well aware, UBS also used exactly the same statement before its downfall. Additionally, Schwab has been actively contacting smaller clients through email to reassure them that their accounts are fully insured by the FDIC up to $250,000, which is undoubtedly true. Despite the fact that the US government is backing these deposits, nobody wants to have their money held while they wait for Joe Powell to issue them their money. We may infer that the bank made some risky investments that led to substantial losses, but these are simply paper losses so far, and there is a way out unless anything goes very wrong. To begin, there is hope that the asset's value will rise again. If they are held until maturity, they will recover their full value, and if bond prices begin to increase and stop falling prior to the maturity date. Second, like with most other banks, rising interest rates are proving to be quite beneficial for Schwab. If they can concentrate on their winners and distance themselves from their losers, they may be able to transform the downturn into profits. It would appear that this video has come to an end. Thank you for watching this far. If you've enjoyed this video, please subscribe, give it a like, and comment below with your thoughts on what you've seen so far. This is Finance Sense, here to help you stay updated on all the most recent developments in the world's economies and financial markets. Have a nice day, and we'll see you in the next video.